Good evening, everyone. I am Janina Pauline Samulde, and I'll be discussing the financial reporting. So let's get into it. And what is financial reporting? Financial reporting is a formal record of the financial activities of the business, person, or other entity. It's like the process of documenting, communicating financial activities, and performance over specific time periods, typically on a quarterly or yearly basis. Companies use financial reports to organize accounting data and report on current financial status. And by the way, the process of preparing the corporation financial statement is in accordance with GAAP, or Generally Accepted Accounting Principles. And the statements prepared includes an income statement, a balance sheet, and a statement of cash flows that I will be discussing later on. And let's move on to annual report. So usually company publish a formal report at the end of each financial year for legal and necessity reasons. And there are three broad sections of the annual document. This is the director's report, financial statements, and audit report. We'll be discussing the two, which is the director's report and financial statements. So the first section of the annual report, called director's report, it is a narrative, often in the form of a letter from the company's chairman to its shareholders, giving three important pieces of information. So firstly, it is a comment on the performance of the company during the year to which the report relates. So this part is often referred to as operational financial review. So let's proceed to the second, an assessment of what lies in the immediate future. And third, a statement about the company's policy, principles, and strategy developed to meet the challenges of the future. And that's it for director's report. Okay, let's move along. The narrative part of the annual report is prepared with great care. Professionals, writers, and designers are hired to touch it up to ensure its acceptability and appeal to the shareholders. So there's a number of graphs, charts, and photographs that are inserted here. So the only issues talked about are which the management feels that will be interest and appreciated by the shareholders. And unfortunately, over recent years, the said report, or the annual report, is losing some of its credibility as more and more investors tends to look at it as a public relations exercise rather than a serious attempt to give meaningful information to shareholders. That's for narrative part of annual report. And the section after it's still under the director's report, the narrative part of annual report. Okay, the second section that we'll be discussing is the financial statement. This report comprised of four financial statements, namely balance sheet, income statement, funds flow statements, and statement showing movements in equity. Okay, Each statement is accompanied with a large number of notes providing explanation of items therein. So those accounts, those financial statements are considered to be as important as the accounts themselves, as they provide an insight into the company's accounting policy and manner of treating various financial items. So first off, income statement. It shows the profit or loss made by the company in the year under reporting. Under report, sorry. Three distinct part. It has three distinct parts. So the first one is the trailing accounts. This part shows the sales revenue earned by the company, the total of directors' costs incurred to earn that revenue, and the resultant gross profit earned by the company. Okay, the second one is profit and loss account. This starts with the figures of gross profit. For gross profit, to which are added all incidental incomes, arriving at the figures of gross operating profit. And from this figure is deducting the total of all other expenses or overheads to arrive at the year's net profit figure. And for the third one is profit and loss appropriation account. So this part shows how the profit earned during the year is being used. From the figure of net profit for the year, deduction of applicable corporation tax is shown to arrive at the profit after tax for the year. Okay. The second financial statement that we're going to discuss is cash flow statement. So what is cash flow statement? It is a movement in funds, generally taken to mean cash and near cash item over the year. And it should be appreciated that the definition of accounting net profit is an increase in assets or equity of a company arising out of its operations. So, an increase in net assets does not necessarily mean an increase in cash. A number of expenses not even paid in cash, for example, is depreciation, or may not be booked by but not yet paid, or accruals. On the other hand, a number of incomes may not be received in cash and may not yet be credited to the year's profit. And at the same time, a part of cash earned out of the year operations may have been used to increase the level of certain assets, like increase in stocks or to entire debt, while some cash may have been received without passing through the income statements. And for the third financial statement, that is balance sheet. So the balance sheet is the asset and liabilities of the company at the end of the financial year. The liabilities side shows the equity and long-term liabilities, and the asset side shows the total of fixed asset, intangible assets, investments, and working capital. Hence, each side of the balance sheet shows the total of capital employed. So don't be confused. Capital employed is a measurement. It's like capital employed equals the total asset minus current liabilities, or capital employed equals to equity plus non-current liabilities. So the capital employed equals to the total assets minus the current liabilities. It's just simple as that. And that's it for the financial reporting, and thank you. Good evening, everyone.
Good evening, everyone. I am Abriel Santos, and for the next topic, I will be discussing the need for publishing financial statements. So, the financial statements published by a company at the end of every financial year serve three main purposes: the information function, the control function, and the planning function, which we will be delving on one by one. Let's start with the information function. The information function. A large number of people have an interest in the affairs of company, and yung people na yon are referred to as the stakeholders. Stakeholders include shareholders, lenders, suppliers, customers, managers, employees, prospective investors, relevant governmental departments, and the public at large. Stakeholders ay nahati sa dalawang categories: internal users and external users. Internal users of accounting information are also known as primary users, or those people who run and manage the day-to-day business activities of the inside area of a company, such as owners and stockholders, directors, managers, officers, internal departments, and employees. Important sa mga nabanggit na stakeholders ang accounting information for many reasons. Example, through this information, na-evaluate ng management and ng directors yung mga obligation na kailangan nilang i-carry out regarding protecting and dealing with the organization's assets. Sa case naman ng investors or potential investors, it helps them in making decisions on when to borrow or invest company funds. Sa managers naman, the data helps them kung, for instance, mag-expand ba sila to another branch or magda-downsize muna. On the other hand, external users of accounting information are the people who are outside the company but use accounting information for their own purposes. For example, in the part of the owners and prospective owners, through these financial statements, they can assess their short and long term decisions like, has the business enterprise earned best earnings on its general investment? Should we invest in this company? Should the current investment in the company be increased, decreased, or maintained at the same level? For creditors and lenders naman, they can ask the questions, should the company be granted a loan? Can the entity pay its obligations as they become due? Sa mga customers naman, does the business offer quality goods at reasonable costs? Will the business endure sufficiently long to respect its product warranties? And as of the general public, is the organization giving valuable products and services and productive work for citizens without causing genuine natural issues, more specifically, environmental problems? Kasi 'di ba may mga businesses like mining or coal, uh, na nakakapag-affect sa environment in a negative or dangerous way. Like nakapag-cause ng pollution, ganyan. In conclusion, accounting and financial information is important because it enables internal and external users to find, measure, classify, and evaluate operations and activities of an organization to substantiate and make a decision. Next purpose of publishing financial statements is the control function. The complexities in the size of the business make it necessary for the management to have up-to-date, accurate, and detailed information about the business and its financial position. Yung financial position na yun nakatulong sa management to understand the company's performance in comparison to other businesses in the sector. Providing management with accurate information enables them to form proper policies for the companies and make correct decisions. These financial statements track the performance of management. Therefore, nagsiserve to as an important benchmark for measuring the efficiency of the managers. The performance of these statements will help management justify their work to all the parties involved in the business. Lastly is the planning function. From the word itself, planning. These financial statements serve as the basis for that particular financial year para makapag-plan ahead based on that information, such as what areas to improve on, Does the management need to minimize costing in this particular department or ma-reach ba natin yung goal natin na 5 million profit? For instance, yung pagpaplano ng movement ng cash. Financial reporting allows finance teams in the business to track and analyze cash inflows and outflows to help identify current and future cash flow risks. This ensures that the organization has sufficient cash flow to grow the business and take advantage of opportunities when they arise. And that's it for the need to publish financial statements. Next, we will discuss the limitations to financial statements. Financial statements are a very useful source of information to all those people who have an interest or stake in the company, as discussed earlier. However, financial statements also suffer from some inherent defects that are beyond the company's control. First one is most balance sheets show values of assets, in particular the fixed assets, at cost less accumulated depreciation. These values may be vastly different from the prevailing market value of these items. Ano muna yung tinatawag natin na intangible assets? An intangible asset is an identifiable non-monetary asset without physical substance, hindi nahawakan. Examples nito are patents, copyrights, and licenses. Basically, many intangible assets are not recorded as assets. Instead, any expenditures made to create an intangible asset are immediately charged to expense. This policy can drastically underestimate the value of a business, especially one that has spent a large amount to build up a brand image or to develop new products. It is a particular problem for startup companies that have created intellectual property but which have so far generated minimal sales. Second one, financial statements may not be comparable because the accounting policies of companies differ even within an industry. Example, one company may not treat a sale as a sale till the goods are paid for by the customer, while yung another company magko-consider na yung sale na yun as a sale as long as na-deliver na siya sa the customer. Third limitation, financial statements contain absolute figures. For the purpose of evaluating financial performance or position, it is often necessary na i-compare ang company's figures with those of other companies or sa average of industry. Example, financial statements are not adjusted for inflation. If the inflation rate is relatively high, the amounts associated with assets and liabilities in the balance sheet will appear inordinately low since they are not being adjusted for inflation. This mostly applies to long-term assets such as land, building, and equipment. Fourth and last limitation, certain assets and or liabilities may not be shown in the financial statements. Example, contingent liabilities are often shown only in notes to the accounts, and similarly, a company may opt not to show disputed receivable amount in its balance sheet till it is actually received. Other limitations also include financial assets as it does not cover non-financial issues such as environmental attentiveness of a company's operations, how well it works with the local company, or kung natatrato ba ng tama yung mga employees. Also, financial statements have no predictive value. The information in a set of financial statements provides information about either historical results or financial status of a business as of a specific date. Another limitation, the financial statements could be wrong due to fraud. The management team of a company may deliberately skew or manipulate yung mga results presented para lang ipakita na maganda yung kalagayan ng company or ng business kahit hindi naman talaga. All in all, financial statements are normally quite useful documents, but it can pay to be aware of the preceding issues before relying on them too much.
Good day, everyone. I'm Zaros Otinebro, reporting qualities of financial statement and responsibility for the health of financial statements. First, we have qualities of financial statement, which is kung ano yung kailangan natin makita or kung ano yung kailangan nilalaman ng papel o anong pagkakaayos nito or paano ito magiging presentable. Dahil hindi lang naman tayo yung makakita ng sarili nating gawa. May makita rin mga stockholders, board of directors, or other members ng ating company. A good set of financial statements should have the following qualities. Una, each statement should be clear and understandable. Siyempre yung paper natin dapat malinis or hindi gaanong kakalat yung paper, yung nasa linya, ganon, or understandable by means of hindi yung paper natin mali yung nakalagay na kunyari, ito ay balance sheet, pero nakalagay ito in income statement. dapat kung ano yung pinaka nandoon sa paper or kung ano yung nilalaman, ay yung maayos yung label, maayos yung mga nakalagay sa mga columns, mali, yung spelling tama or yung kung ano yung pagkakaayos, nasa ayos, ganun. And next naman yung the statements should be reliable. Reliable by means na yung nasa paper natin, kung ano yung nandun, nandun. Walang ganong inalter, hindi binawasan, may hindi tama dun sa value, hindi tama dun sa pagka-balance, and it connects sa number 3. The statement should be honest. Yun nga, sa sinabi ko na dapat hindi naka-alter, hindi dinaya, syempre, hindi yung ipapatan sa mga members, diba, at dadayain. Or kung dadayain man natin, syempre hindi na ganoon ka valuable yung paper natin kung may pandadaya. Syempre sa lahat ng bagay, kung may pandadaya, hindi naman na nasa ayos yung pinaka-result. Diba? And last, the statement should contain all the disclosures required by the various regulatory bodies. Yung paper natin, hindi naman lahat kailangan na doon nakalagay. Lahat ng part ng financial position or lahat ng financial statement nandoon. Siyempre may mga iba't ibang requirements din doon kung ano yung kailangan lang like yung income statement lang nandoon, yung balance sheet lang nandoon. May mga requirements din na kailangan sinusunod doon. Hindi lahat kailangan nakalagay. Kasi kung lahat doon nakalagay, masyadong crowded. Hindi naman, yung iba doon hindi naman gagamitin. Yung iba unnecessary. For the second topic, responsibility for the health of financial statements, which is yung mga na-position para sa dun sa pangangalaga ng financial statement and kung ano yung ginagawa nila. The parties related to and sharing responsibility for financial statements. First, we have the management who keeps the books, chooses the accounting policies, maintains the books of accounts, prepares the financial statements, and facilitates the external auditor. Which is sila yung nag-aayos at sasaayos, sila yung nasa pinatuktok na pag-aayos ng financial statement. Sila yung gumagawa rin ng financial statement. Sila yung nag-aayos kung paano yung financial statement natin, kung ano yung pagkakaayos, kung ano yung pagkakakailangan. And sila din yung nagpapasa sa mga external auditor natin para sa distribution of files. Next, we have the board who oversee the preparation of accounts, prepares the director's report, ensures that all due legal disclosures are made, present the financial statements to the shareholders and file them with KSE and SCP. Dito naman, yung board, sila yung mga board of directors. Sila yung mga nagpo-file, sila yung nag-a-assist sa ayos sa mga papers na kakailanganin para i-manage ng finance ng management dun sa financial statements. Sila din yung nagkasaayos ng legal processes kasi may mga kailangan na i-input doon sa paper. And sila din yung nagko-file para sa KSE and SECP. Sila yung mga nag-officiate or nag-validate ng paper. Next, we have audit committee, who liaises with the internal and external auditors and recommends the financial statements to the board. After may sagawa yung financial paper, yung financial positions, or yung mga kailangan na papers, may mabasa ito sa audit committee, which is na ipag-cooperate ito sa mga internal and external members natin, and also sa ating board. Yung kung ano yung mga kailangan pa idagdag, or kung ano ba yung kailangan may pakita sa ating mga external members. Or kung ano yung pinaka-financial statement natin. Kailangan ng opinion from them para hindi kung may mali, may hindi napansin, or may kailangan idagdag. Which connects sa ating external auditor who examines the accounting and related records as well as the financial statements and gives a formal opinion to them. Same lang sa nasabi ko kanina. Meron sa paper kasi hindi naman ayun yung kailangan pagkatapos sa management, ipapasa siya kagad and ipapakita sa public and ipapakita sa mga members. May kailangan pang i-check, i-examine, or i-officiate kung may dagdag, may mali, may bawas, o may kailangan pang ayusin. Kasi kung may mali kang mailagay or may mali na nailagay doon sa financial statement, magiging reliable ng ating paper. Di na siya ganun ka-valuable, which is baka magkaroon pa ng problem. Kaya may mga internal, external, and board tayo para mag-give ng opinion, mag-give kung ano yung mga kailangan, or mag-give kung ano yung mga kailangan pa idagdag.
Hi everyone, my name is Ira May El Caranto and I'm going to discuss the next topic, which is the description of financial analysis and six-step process of financial analysis. Financial analysis. Financial analysis is the process of evaluating financial and other information for decision making. Here it says evaluating financial, which means it includes projects, budgets, or any financial related transaction of a company or business. Or sa mas madaling pagpapaliwanag, ang financial analysis ay proseso ng pag-e-examine ng financial information ng isang business or company upang malaman kung ito ba ay may abilidad na maibalik ang kanyang capital or maging profitable enough. Ito ay ine-examine using the balance sheet, financial statements, or cash flows. Financial analysis is a process of analyzing and interpreting financial statements. Analyzing means simplifying the data, and interpreting means explaining the meaning and significance of data so simplified. Critically examining the accounting information given in the financial statements. Evaluating relationship between the component parts of financial statements to obtain a better understanding of firm's position and performance. There are six-step process in financial analysis. First is identify purpose of financial analysis. So to start the process, kailangan natin identify kung ano nga ba ang purpose ng ating financial analysis. We need a specific objective para maging malinaw ang magiging pag-aanalisa or para maging incline ang pagpoproseso nito. For example, ang purpose ng analysis nyo is para makita kung profitable ba yung gagawin yung project or para makita yung growth ng inyong company. Step 2 is the corporate overview. Sa prosesong ito naman ay makikita ang mga basic background information ng company like mga business plans, executives, or iba pang important points ng isang company. And by that process, makakakuha tayo ng important information na ating magagamit sa susunod na hakbang upang makabuo ng better decisions at para na rin may disclose ito sa public. Next step is the financial analysis techniques. For the third step process of financial analysis, it includes the summarizing financial reporting data and evaluating the performance and financial position of a company. And through this, makakakuha tayo ng mga important inputs. So dito na papasok ang mga financial techniques like horizontal and vertical analysis, which will be discussed later on. The next step will be detailed accounting analysis. In this process, it can be explained as an assessment of the stability, viability, and profitability of a business or project. It is complex and in-depth understanding of both data and the company. Iilan sa mga method ng accounting analysis ay ang tinatawag nating past performance, future performance, or yung tinatawag na comparative performance. For the next step, we have comprehensive analysis. It refers to the complete analysis of every relevant aspect of a company's financial operations. It provides a complete picture of the financial status of a company both in the current time and projected in the future. Dito na kinukuha yung mga current financial reports and also from the past. And for the last step, we have the decision or recommendation. So after all the steps or process, dito na magkakaroon ng decision or recommendation ang isang company na kung saan magagamit nila ito upang magkaroon ng improvement. For example is yung result or yung decision, gagamitin nila ito upang makita kung saan silang part hindi nag-excel. And by that, makakapag-focus sila rito at magkakaroon sila ng chance to improve.
Good evening, everyone, especially to our Professor Richard Desilio. Now let's talk about financial statement. What is financial statement? Financial statements are the collections of summary level reports about an organization's financial results, financial positions, and cash flows. They include the income statement, balance sheet, statement of cash flows, and the statements of owner's equity. Financial statements have many advantages, like to determine the ability of a business to generate cash and the sources and uses of that cash, to determine whether a business has the capability to pay back its debts, to track financial results on a trend line, to spot any looming profitability issues, to derive financial ratios from the statements that can indicate the conditions of the business, to investigate the details of a certain business transactions as they outlined in disclosures that accompany the statements. If the financial statement has the advantages, of course, it also has disadvantages. There are a few downsides to issuing financial statements. A possible concern is that they can be fraudulently manipulated, leading investors to believe that the issuing entity has produced better results than was really the case. Such manipulations can also lead a lender to issue debt to a business that cannot realistically repay it. Another concern is that financial statements are entirely historical in nature and so can be misleading when used to project the future results of a business. For example, a business that relies on a government contracts might report robust results for its most recent period and yet have no additional sales on top since it's just completed all of the contracts that it had been awarded. To understand the financial statements, investors and financial analysts rely on financial data to analyze the performance of a financial and make predictions about the future directions of the company's stock price. One of the most important resources of reliable and audited financial data is the annual report, which contains the firm's financial statements. When you say annual report, there are comprehensive documents designed to provide readers with information about the company's performance in the preceding year. The reports contain information such as performance highlights, a letter from the CEO, financial informations, and the objective and goals for the future years. There are two categories of financial statements that companies can release. This is the compiled and certified statements. The compiled statements, the usual reasons for the release of compiled statements before they are certified is timeless. The company has financial information that it wants or needs to be released promptly to investor. The certifying process would delay its disclosure. The usual results for the release of compiled statements before they are certified is appointed to compile the statement must be familiar with the company and its business process, and an accountant who finds erroneous, misleading, or incomplete information in a financial statement must notify management or abandon the task because there is no auditing involved. These statements can be produced at a lower cost. On the certified statements, is an income statement, balance sheets, or a statement of cash flows that is issued along with an audit report from a certified public accountant. In the audit report, the auditor attests to the accuracy of the financial statements. Certified financial statements are needed by the investments, communities, and the creditors who might otherwise be uncertain about the accuracy of an entity's financial statements. These are the four types of financial statements. The first one is balance sheet. One of the financial statement is the balance sheets. It shows an entity's assets, liabilities, and stockholders' equity as of the report date. In this report, the total of all assets must match the combined total of the liabilities and equity. How the balance sheet is structured. The balance sheets, like all financial statements, will have minor differences between organizations and industries. However, there are several buckets and lines items that are almost always included in a common balance sheets. We briefly go through commonly found line items under current assets, non-current assets, long-term assets, current liabilities, long-term liabilities, and equity. For the current assets, cash and equivalents, the most liquid of all assets, cash appears in the first line of the balance sheet. Cash equivalents are also lumped under this line item and include assets that have short term maturities under 3 months or assets that a company can liquidate on a short notice. Account receivable. The balance of all sales revenue still on credit, net of any allowance for doubtful accounts. As a company recovers account receivable, this account decreases and cash increases by the same amount. Inventory includes among amounts for raw materials, work in process goods, and finished goods. The company uses this account when it reports sales of goods, generally under cost of goods sold and the income statement. For the non-current assets, plant, property, and equipment, also known as PP and E, capture the company tangible fixed assets. This line item is noted net of accumulated depreciation. Some company will class out their PP&E by the different types of assets, such as land, building, and various types of equipment. Intangible assets. This line items includes all of the company's intangible fixed assets, which may or may not be identified. Identifiable intangible assets includes patents, licenses, and secret formulas. Current liabilities, accounts payable, is the amount of a company owes suppliers for items or services purchased on credit. As the company pays of its AP, it decreases along with an equal amount decrease to the cash accounts. Current debt or notes payable includes non-accounts payable obligations that are due within 1 year's time or within one operating cycle for the company. Notes payable may also have a long-term version, which includes notes with a maturity of more than 1 year. Current portions of long-term debt. This account may or may not be lumped together with the above account. Current debt, while they may seem similar, the current portions of long-term debt is specifically the portion due within this year of a piece of debt that has maturity of more than 1 year. For example, if a company takes on a bank on a bank loan to be paid off in 5 years. This account will include the portions of the loan due in the next year. For the non-current liability, bonds payable. This account includes the amortized amounts of any bonds the company has issued. Long-term debt is the total amount of long-term debt, including the current portions if that account is present under current liabilities. This account is derived from the debt schedule, which outlines all of the company's outstanding debt, the interest expense, and the principal repayment for every period. Shareholders' equity. There's a share capital in shareholders' equity. This is the value of funds that shareholders have invested in the company. When a company is first formed, shareholders which typically put in cash. Retained earnings. This is again retained earnings. This is the total amount of net income the company decides to keep. Every period, a company may pay out dividends from its net income. Any amounts remaining or exceeding is added to retained earnings. Let's talk about the importance of the balance sheet. The balance sheet is very important financial statement for many reasons. It can be looked at on its own and in conjunctions with other statements like the income statement and cash flow statement to get full picture of a company's health. There are four important financial performance metrics. The first one is liquidity. Current assets should be greater than current liabilities, so the company can cover its short-term obligations. The current ratio and the quick ratio are example of liquidity financial matrix. The second one is leverage. Debt to equity and debt to total capital are common ways of the assessing leverage on the balance sheet. The third is the efficiency. By using the income statement is connections with the balance sheet, it's possible to assess how efficiently a company uses its assets. For example, dividing revenue by the average total assets produces the assets turnover ratio to indicate how efficiently the company turns assets into revenue. Additionally, the working capital cycle show how well a company manages its cash in the short term. And the last one is rates of return. The balance sheets can be used to evaluate how well a company generate returns. For example, dividing net income by the shareholders' equity produces returns on equity, and dividing net income by total assets produces returns on assets, and dividing net income by debts plus equity results in return on investments capital. Another financial statement is the income statement. It shows the results of an entity's operations and financial activities for the reporting period. It usually contains the result for either the past months or the past year. It may include several periods for comparison purposes. Its general structures is to begin with all revenues generated from which the cost of goods sold is subtracted, and then all selling, general, and administrative expense. The result is either a profit or loss, which is net of income taxes. This report is used to discern the ability of a business to generate a profit. The income statements have many minor variations between different companies, as expenses and income will be dependent on the type of the operations or business conducted. However, there are several generic line items that are commonly seen in any income statement. Okay, there are 13 most common income statement items. First, revenues or sales. Sales revenue. This value will be the gross of the costs associated with the creating the goods of sold or in providing services. Some companies have multiple revenue streams that add to the total revenue line. Second, cost of goods sold. This line item can also be called cost of sales. If the company is a service business, direct costs can include labor, parts, materials, and allocations of other expenses such as depreciations. Third, gross profit. Gross profit is calculated by subtracting cost of goods sold or cost of sales from sales revenue. Fourth, marketing, advertising, and promotion expense. Marketing, advertising, and promotion expense are often grouped together as they similar expenses, all related to selling. General and administrative expense. This includes salaries and wages, rent and office expenses, insurance, travels expenses, and sometimes depreciations and amortizations, along with other operational expense. Entities, however, elect to separate depreciations and amortizations in their own sections. EBITDA stands for earnings before interest, tax, depreciations, and amortizations. It is calculated by subtracting SG and A expense, including and depreciations from gross profit. Depreciations and amortization expense are non-cash expense that are created by accountants to spread out the cost of capital assets such as property, plant, and equipment. Operating income, in other words, it's profits before any operating income. Non-operating expense, interest or taxes are subtracted from the revenues. EBIT is a term commonly used in finance and stands for earnings before interest and taxes. Interest. Interest expense. This is done in order to reconcile the difference between EBIT and the EBT. Interest expense is determined by the debt schedule. Other expenses. Business often have other expenses that are unique to industry. Other expenses may include fulfillment, technology, research and development, stock-based compensations, impairment charges, gains losses on the sales of the investments, foreign exchange impacts, and many other expenses that are industry or company specific. The EBT are the pre-tax income. EBT stands for earnings before tax, also known as the pre-tax income, and is found by the subtracting interest expense from operating income. This is the final subtotal before arriving at net income. Income taxes. The total tax expense can consist of both current taxes and the future taxes. Net income. This is the amount that flows into retained earnings on the balance sheet after deductions for any dividends. Another financial statement is the statement of a cash flows. It shows changes in an entity's cash flows during the reporting period. These cash flows are divided into cash flows from operating activities and investing activities and financing activities. The bulk of all cash flows are generally listed in the operating activities sections, which state the cash inflows and outflows related to the basic operations of the business, such as from changes. Okay, let's go back. Sorry for the distractions. Again, the bulk of all cash flows are generally listed in the activities sections, which states the cash inflows and outflows related to the basic operations of the business, such as from changes in receivable inventory and payable balances. There are three classifications of cash flows. The first one is operating cash flows, indicate whether a company can generate sufficient positive cash flow to maintain and grow its operations. Otherwise, it may require external financing for capital expansions. The company chief financial officer or the CFO chooses between the direct and indirect presentations of operating cash flow. The first presentations is direct presentations. Operating cash flows are presented as a list of a cash flows, cash cash in from sales, cash out for capital expenditures, etc. This is a simple but rarely used method as the indirect presentations is more common. The second presentation is indirect, presents the statement of cash flows beginning with net income or loss, with subsequent additions to or deductions from that amount for non-cash revenue and expense items, resulting in a cash flow from operating activities. The second classification of cash flow is investing cash flows. Investing cash flows reports how much cash has been generated or spent from various investment related activities in a specific period. Investing activities include purchases of speculative assets, investments in the securities or the sales of securities or assets. And the third classification of cash flows is financing cash flows. It shows the net flows of cash that are used to fund the company and its capital. Financing activities include transactions involving issuing debt or equity and paying dividends. The fourth and last type of financial statement is statements of owner's equity. The statement of owner's equity portrays changes in the capital balance of a business over a reporting period. The concept is usually applied to sole proprietorship, where income earned during the period is added to the beginning capital balance and owner draws are subtracted. The result is the ending balance in the capital account. The amount of owner's equity is increased by income and owner contributions. The balance is decreased by losses and owner's draw. There are four main components of owner's equity. The first The first component of owner's equity is retained earnings. The retained earnings, net of income from operations and other activities, represents the returns on the shareholders' equity that are reinvested back into the company instead of distributing it as dividends. The amount of the retained earnings grow over the time as a company reinvests a portion of its income, and it may form the largest components of the shareholders' equity for companies that have existed for a long time. The second one is the outstanding shares. The number of outstanding shares is taken into account when accessing the value of shareholders' equity. The third component of owner's equity is treasury stock. The amount of treasury stock is deducted from the company's total equity to get number of shares that are available to investor, and the last components of owner's equity is the additional paid in capital. It is calculated by getting the difference between the par value of the common stock and the par value of preferred stock, the selling price, and the number of the newly sold shares. Now, let's talk about the second main topic of my report, the financial statement analysis. What is financial statement analysis? Financial statement analysis is evaluates a company performance or value through a company's balance sheets, income statements, or a statement of cash flows by using a number of techniques such as horizontal, vertical, or ratio analysis. Investors may develop a more nuanced pictures of a company's financial profile. So, who uses financial statements analysis? 1. Creditors. Anyone who has lent funds to a company is interested in its ability to pay back the debt, so will focus on the various cash flows measures. The second, investors. Both current and prospective investors examine financial statements to learn about companies' ability to continue issuing dividends or to generate cash flows or to continue growing at its historical rates. It's depending upon their investment philosophies. Third, management. The company controller prepares an ongoing analysis of the company's financial results, particularly in relations to a number of operational metrics that are not seen by the outside entities, such as the cost per delivery, cost per distributions channel, profit by the product, and so forth. The last one is regulatory authorities. If a company is publicly held, it is a financial statements are examined by the Securities and Exchange Commissions to see if the statements conform to the various accounting standards at the rules of the SEC. There are two kinds methods for analyzing financial statements. The first method is the use of horizontal and vertical analysis. Horizontal analysis, the comparison of financial information over a series of reporting periods, while vertical analysis is the proportional analysis of financial statements, where each line item on a financial statement of an financial financial statement is listed as a percentage of another item. Typically, this means that every line item on an income statement is stated as a percentage of gross sales, while every line item on a balance sheet is stated as a percentage of a total asset. The second method for analyzing financial statement is the use of many kinds of ratio. Ratio are used to calculate the relative size of the number in a relation to another. After a ratio is calculated, you can then compare it to the same ratio calculated for a prior period, or that is based on an industry average to see if the company is performing in accordance with expectation. Now, I'll discuss the second method used to analyze the financial statement. The first one is liquidity ratio. Liquidity ratio is a type of financial ratio used to determine a company's ability to pay its short-term debt obligations. The metric helps determine if a company can use its current or liquid assets to cover its current liabilities. There are four types of ratio under liquidity, and these are the current ratio. Current ratio is a measure of a company's near-term liquidity positions, or more specifically, the short-term obligations coming due within 1 year. Quick ratio is used to evaluate whether a business has enough liquid assets that can be converted into cash to pay its bills. Cash ratio is a measurement of a company's liquidity. It specifically calculates the ratio of a company total cash and cash equivalents to its current liabilities. The last ratio under liquidity is operating cash flow ratio. Is a measure of a number of times a company can pay off current debts with the cash generated within the same period. A high number greater than 1 indicates that a company has generated more cash in period than what is needed to pay off its current liabilities. Activity ratio shows the connections between sales and a given assets. It indicates the investment in one particularly groups of assets and the revenue the assets are producing. So what are the different activity ratio? First one is account receivable turnover, also known as debtors ratio, is an activity ratio that measures the efficiency with which the business is utilizing its assets. It measures how many times a business can return its account receivable into cash. It calculated by dividing the net credit sales during a specific periods by the average account receivables. The average account receivable is calculated by adding the value of the accounts receivable at the beginning of the desired period to the value and the and and then dividing it by 2. Working capital ratio is indicate a business effectiveness in utilizing its working capital. Working capital is the total amount of the current minus the current liabilities. The ratio is calculated by dividing the net sales by the working capital. The ratio helps you figure out the net annual sales generated by the average amount of a working capital during year. Next, assets turnover ratio. This ratio is calculated at the end of financial year and can widely from one industry to another. The higher the assets turnover ratio, the better the company is performing. The next one is fixed asset turnover ratio. This ratio measures the business ability to generate sales from fixed assets such as property, plant, and equipment. To calculate the ratio, you need to divide the net sales by the total property, plant, and equipment net of accumulated depreciation. Inventory turnover ratio. The ratio shows how well the business manages its inventory levels and how frequently they are replenished. It is calculated by dividing the cost of goods sold by the average inventory for the same period. Days payable outstanding. The ratio measures the number of days a business takes to pay its invoices and bills to its inventors, suppliers, or the other companies. The number of days is taken as 90 days for quarter or 365 days for a year. The ratio indicates how well the cash flow is being managed. A ratio is usually beneficial for the business. When a business takes longer to pay its bills, it has available cash for a longer period for managing operations, producing more goods, and its short-term investment. Next, leverage ratio. Leverage ratio is the third ratio method used to analyze financial statements. Leverage ratio are used to determine the relative level of debt load that a business has incurred. This ratio compared the total debt obligations to either the assets or equity of a business. A high ratio indicates that a business may have incurred a higher level of debt that it can be reasonably expected to service with ongoing cash flows. Under leverage ratio, there is debt to equity ratio. It measures the riskiness of a company's financial structure by comparing its total debts to its total equity. The ratio reveals the relatively proportions of debt and equity financing that a business employs. It is closely monitored by lenders and creditors. The second ratio under leverage is debt service coverage ratio. It measures whether business has sufficient cash flows to pay its debt obligations. In essence, it compares cash flows to debt service payments. If a positive debt service ratio indicates that an organization's cash flows can cover all offsetting debt, while a negative ratio indicates that the business must contribute additional funds to pay for the annual loan payment. This is the only possible if the business has substantial cash reserve or access to additional funds from investors. The third and last ratio under leverage ratio is fixed charge coverage. The fixed charge coverage is used to examine the extent to which fixed costs consume the cash flows of a business. In effect, it shows how many times a business can pay for its fixed costs with its earnings before interest and taxes. The ratio is most commonly applied when a company has incurred a large amount of debt and must make ongoing interest payments. If the resulting ratio is low, it is a strong indicator that any subsequent drop in the profits of a business may bring about its failure. Conversely, a high ratio indicates that a business can safely use more debt to fund its growth. The ratio is typically used by the lenders evaluating an existing or prospective borrowers. Profitability ratio is the fourth ratio method used to analyze the financial statement. These ratios are a class of financial metrics that are used to assess a business ability to generate earnings relative to its revenue, operating costs, balance sheet assets, or shareholders' equity over time using data from a specific point in time. There are four types of profitability ratio. The first one is break even point. Break even point is a sales volume at which business earns exactly no money. At this point, a business is able to cover its fixed expenses. The break even point is useful for determining and amount of the remaining capacity after the break-even point is reached, which tells you the maximum amount of profit that can be generated. Second, contributions margin ratio is the difference between a company's sales and variable expense expressed as a percentage. The total margin generated by an entity represents the total earnings available to pay for fixed expense as generated a profit. When used on an individual unit sale, the ratio expresses the proportions of profits generated on that specific sale. Third, gross profit. It shows the proportions of profits generated by the sales of productions or services before selling, and administrative expense is it's, it is used to examine the ability of a business to create sellable products in a cost-effective manner. The ratio of some importance, especially when tracked on the trend line, to see if a business can continue to provide products to the marketplace for which customers are willing to pay a reasonable price. Fourth, margin of safety is the reductions in sales that can occur before the break-even point of a business is reached. The informs management of the risk of law to which business is subjected by changes in sales. The concept is useful when a significant proportions of a sales are the risk of decline or eliminations, as may the case when a sales contract is coming to an end. And minimum margin of safety might trigger actions to reduce expense. The opposite situations may also arise where the margin of safety is so large that a business is well protected from sales variations. Fifth, net profit percentage is the ratio of after-tax profits to net sales. It reveals the remaining profits after all costs of productions, administrations, and financing have been deducted from sales and income tax recognized. As such, it is one of the best measures of the overall results of the firm, especially when combined with an evaluation of how well it is using its working capital. Six, return on equity ratio reveals the amount of a return and on the shareholder equity invested in business. The measurement is commonly used by investors to evaluate current and prospective business prospective business investments. These returns can be improved when a business buy back its own stock from investors or by using more debt and less equity to fund its operations. Seventh, return on a net assets or RONA. Measures compares net profits to the net assets to see how well a company is able to utilize its asset base to create profits. It can also be used a compare to a performance of a business so that a pre-group a high ratio of assets to profit is an indicator of excellent management performance. And the last one is return on operating assets. One measures a common outcome is the management works to minimize all of the other assets on the books that are contributing to revenue. The calculations for the return on operating asset is to divide net income by the gross recorded amount of all assets used to generate revenue. Now, let's tackle the five methods of financial statement analysis. What are the five methods of financial statement analysis? The first one is the horizontal analysis. This type of analysis also lends insight into the operational results of an organization and whether it is operating efficiently and profitably. It makes it easier to compare growth rates amongst sectors' growth competitors. Second, the vertical analysis is the proportional analysis of financial statement where each line's item on financial statement is listed as a percentage of another item. For example, every line item on an income statement is stated as a percentage of a gross sales, while every line item on a balance sheet is stated as a percentage of a total assets. This give analysis an understanding of overall performance in terms of revenue and expense. The third one is ratio analysis. It is a quick method to obtain an overview of a company's financial health, but also more granular relationships between data, such as debt and equity or a price versus earnings, in addition to liability areas such as staff turnover. Once a ratio has been calculated, it can be compared against the previous period, which is crucial for setting performance targets. Next, trend analysis. Trend analysis is a useful technique as moving with the trends and will result in profits for an investor. And the last methods for financial statement analysis is the cost volume profit analysis. It examines the fixed costs and variable costs and establishes the relationship between sales and variable costs to help business leaders better plan and project profits.
Good evening, everyone. I'm Kimi Raz Carmona, the next reporter. We've already talked about what financial reporting is, the processes in financial analysis, its uses, the types of financial statements. It's time for us now to analyze these financial statements. We will now be tackling the different methods of financial statement analysis. For this topic, we will be solving, so get your calculator ready so you can follow along and practice the formulas. Basic solving lang naman like subtraction, division, percentage. So there are 5 commonplace approaches to financial statement analysis, namely the horizontal analysis, the vertical analysis, the common size statements, the trend percentage, and the ratio analysis. But I'll only tackle the first 2, the horizontal analysis and vertical analysis. The remaining topics will be covered by the following reporter. Before we start, let's first review the basics para mas magets natin ang sense ng topic na ito. Diba ang objective naman ng accounting is to provide information that will be helpful in decision making. So accounting gives the financial managers, the owners, a quantitative informations like the entity's financial position, financial performance, and cash flow. Pero all of these reports will be nonsense if hindi sila i-analyze and i-interpret. For example, at the end of the year gagawa ng FS. So pag-aaralan ito ngayon ng managers and owners kung tumaas ba ang account na to or bakit bumaba o naging successful ba ang kanilang bagong product o bagong in-implement na strategy. So the analysis can help them to confirm past expectations, mga sinet na goals ng company kung na-meet ba at the end of the year or term. Also to evaluate present financial reports, syempre to decide for the betterment of the company. And in connection to that, it also predicts future outcomes. So it is very important for the owners and managers of the entity to be able to evaluate the results of all their business activities. Let's start off with horizontal analysis. So how do we analyze financial statement horizontally? So paano nga bang horizontal? Pahiga, di ba? From left to right. It says here that horizontal analysis involves taking several years of financial data and comparing them to each other to determine a growth rate. This will help an analyst determine if a company is growing or declining and identify important trends. So dito, we will compare and analyze each financial statement account and element of different accounting period. For example, ng account, cash. So i-compare mo ang cash of different account periods, for example, 2019 and 2020. What we're looking here is the percentage change, kung ilang porsyento tumaas o bumaba ang cash from the base year sa current year. Ang base year, ito ang previous term. Kaya base, kasi dito mo i-compare ang iyong bagong term. Dito binabase if positive ba or negative ang result ng current year. To find the percentage change, we use the formula current year minus base year over or divided by base year figure. At since percentage ang pinag-uusapan natin dito, we need to transform the answer to percentage by multiplying it by 100. For this method of analysis, we need a comparative financial statement, meaning financial statement ng 2 consecutive year na pinagtabi. So, ganito siya. So, kung kaya rin horizontal, ay kasi from left to right ang data na i-analyze natin. Pag vertical naman, pababa na. So, sabi sa formula, current year minus base year divided by base year figure times 100. So, isa-isahin natin. Simulan muna nating isolve ang numerator or tinatawag na amount change. To solve for the amount change, current year minus base year. For this balance sheet, ang current year natin is year 2021. Ang base year naman natin ay year 2020. So, for cash, it's 700,000 minus 600,000. The answer is 100,000. From that, pwede mo na isolve ang percentage change, pero to prevent confusion and para mas madali, isolve muna natin lahat ng amount change. So next account is accounts receivable. We have 275,000 for our current year minus 200,000 for our base year. That would be 75,000. For our inventory, we'll have 120,000 minus 100,000. That would be 20,000. For our land, it's 60,000 minus 80,000. The answer would be negative 20,000. Next, we have equipment. 350,000 minus 350,000. The answer is 0, so walang changes. Ngayon naman ay ang total assets. For the current year, we have 1,505,000 minus 1,350,000. We would get 125,000. For our liabilities naman, first is our accounts payable. We have 150,000 minus 115,000. That would be 35,000. Next account is notes payable. 400,000 minus 360,000. That would be 40,000. Our capital, 955,000 minus 875,000. That would be 80,000. Lastly, our total liabilities and capital, we have 1,505,000 minus 1,350,000. The answer is 155,000. So now that we have the amount change of each accounts, we can now proceed sa pag-solve ng percentage change. So that would be amount change over or divided by base year figure. For the first account, which is cash, that would be 100,000 divided by 600,000 times 100 para maging percentage. So that would be 16.67%. For accounts receivable, it's 75,000 divided by 200,000 times 100. The answer is 37.5%. For the inventory, 20,000 divided by 100,000 times 100. The answer is 20%. For the land, it's negative 20,000 divided by 80,000. The answer is negative 25,000. Next, for the equipment, dahil walang changes, the percentage change here is also 0. For the total assets, it's 125,000 divided by 1,350,000 times 100. The answer is 9.06%. Next, for the liabilities, first account is accounts payable. We have 35,000 divided by 115,000 times 100. The answer is 30.43%. For the notes payable, it would be 40,000 divided by 360,000 times 100. The answer is 11.11%. For the capital, it would be 80,000 divided by 875,000 times 100. The answer is 9.14%. And lastly, for total liabilities and capital, we have 115,000 divided by 1,350,000 times 100. We would get 11.48%. So how does these numbers make sense? So kung noong 2020, 600 lang cash mo, tapos noong 2021 naging 700,000, meaning tumaas ng 100,000 o 16.67% ang iyong cash. So this is now our horizontal analysis. Magkakaroon ka ng link sa dati mong transactions. This also confirms what happened to the past. These numbers ay magkakaroon lamang ng sense if mai-interpret na. Try naman natin ang formula ng hindi gumagamit ng table para sa mga word problem. Again, our formula for percentage change is current year minus base year over base year figure times 100. For example, yung cash mo nung year 2021 is 700,000. Nung year 2020 naman is 600,000 lang. So the solution would be like this. 700,000 minus 600,000 over 600,000 times 100. So that will lead you to 100,000 over 600,000 times 100. The answer is 16.67%. So we would get the same answer sa ginawa natin kanina sa table. Paano naman sa income statement? Ganun pa rin naman. So to solve for the amount change, so current year minus base year pa rin. So for net sales, 5 million minus 4 million. We would get 1 million. For the percentage change, ganun pa rin. Amount change divided by base year figure times 100. So that would be 1 million divided by 4 million times 100, we would get 25%. For the cost of goods sold, we have 3 million minus 2,400,000. That would be 600,000 divided by 2,400,000 times 100. The answer is 25,000. For the gross profit, 2 million minus 1,600,000, the amount change would be 400 divided by 1,600,000 times 100. The answer is 25,000. Next, for the other income, 200,000 minus 300,000, that would be negative 100 divided by 300,000. The answer is negative 33.33%. For the revenues, 2,200,000 minus 1,900,000, the amount change would be 300,000. Then divide it to 1,900,000 times 100. The answer would be 15.79%. For the operating expenses, 800,000 minus 900,000, the answer is negative 100,000. Let's divide it to 900,000 to get the percentage change times 100. The answer would be negative 11.11%. For the net income before tax, we have 1,400,000 minus 1 million. That would be 400,000 divided by 1 million times 100. The answer is 40,000. Next, for the income tax expense, 420,000 minus 300,000. The answer is 120,000 divided by 300,000 times 100. We will get 40%. Lastly, the income tax. 980,000 minus 700,000, that would be 280,000 divided by 700,000 times 100. The answer is 40%. So dito makikita natin na tumaas ng 1 million ang sales sa year 2021. So ngayon, pag-uusapan na ng company nyo kung paano ito nangyari. So punta naman tayo sa operating expense. Bumaba ito ng 100,000. Kahit negative ang amount change, this is a positive result dahil nga expense siya. So ngayon, i-discover nyo paano ito nangyari. So ngayon, ma-realize nyo na pwede pa pala bumaba ang operating expense. So titingnan nyo ngayon at kung pwede pa ba itong babaan. Let us now proceed to vertical analysis. For a single financial statement, each item is expressed as a percentage of a significant total. We can use the vertical analysis to understand the proportions of each line item to the whole, understand key trends that occur over time, compare multiple companies of varying sizes, or to compare a company's financial statements to averages within their industry. So kung kanina sa horizontal analysis, kailangan natin ng comparative financial statement, dito sa vertical analysis, pwede na ang single financial statement. So kanina natin i-compare ang financial statement mo. Ito ay sa ibang company. The keyword here is itong the percentage of a significant total. For example, sa balance sheet, ilang percent ang cash sa total assets ng business mo? Or ilang percent ang iyong notes payable sa iyong total liabilities? Bale, proportion of a whole. What's we're gonna solve here in vertical analysis? It is the percentage of total base figure. So it is statement line item divided by total base figure times 100 to convert to percentage. So anong statement line? Ito yung kung anong account ang iyong isasolve, like cash, supplies, or notes payable. For total base figure naman, ito yung total sa isang report. Sa balance sheet, ito ang total assets or total liabilities. Sa income statement naman, ito ay ang total sales. So ang magiging formula sa balance sheet ay balance sheet item over or divided by total assets or total liabilities times 100. For income statement naman, income statement item over or divided by total sales times 100. Let's try the formula in this simplified balance sheet. For the statement line item, ito yung cash, accounts receivable, inventory, land, equipment. For the total base figure, ito ay ang total assets. Then times 100 since percentage ang hinahanap natin dito. For the first account, cash, the solution would be 700,000 divided by 1,505,000 times 100. The answer is 46.51%. For the accounts receivable, we have 275,000 divided by 1,505,000 times 100. We would get 18.27%. For the inventory, 120,000 divided by 1,505,000 times 100, that's 7.97%. For the land, 60,000 divided by 1,505,000 times 100, it's 3.99%. For the equipment, it's 350,000 divided by 1,505,000. The answer is 23.26%. To check if tama ba ang ating solutions, just add everything in this column. Ang total ay dapat 100%. Let us now proceed sa liabilities. Ang magiging base mo nandito ngayon ay ang total liabilities and capital. Let's try the accounts payable. The solution would be 150,000 divided by 1,505,000 times 100. That's 9.99%. For notes payable, 400,000 divided by 1,505,000 divided by 100, that's 26.58%. For capital, we have 955,000 divided by 1,505,000 times 100, that's 63.46%. So in total, meron tayong 100%. For another example, let us solve for year 2020. So ang base natin dito sa total assets naman ay ang 885,000. So sa cash na 300,000, it's 33.9%. Sa accounts receivable na 100,000, it's 11.3% of the total assets. Sa inventory na 65%, it's 7.34%. Sa land na 120,000, it's 13.56%. Sa equipment na 300,000, it's 33.9%. So in total, we have 100%. Ngayon naman, ang percent of total liability and capital. Ang base natin dito ay ang total liabilities and capital amounting 885,000. For accounts payable na 135,000, that's 15.25% of your total liabilities and capital. For notes payable na 50,000, that's 5.65%. Lastly, for the capital, it's 79.1%. So, paano natin to ngayon i-analyze? Using our accounting formula, which is assets equals liability plus capital, so 100% ang ating assets. Paano kaya natin fini-finance ang ating assets? So, tingnan natin ang ating accounts payable. If mas malaki ito kaysa sa iyong capital, meaning your assets is financed by your utang or equity. So, in this balance sheet, mas malaki ang ating capital. So, our assets is financed through our equity, not from utang. Siyempre, pag mas malaki ang utang mo, debt financing yon. By this data, we can also say that the entity's cash comprises of 46.51%. So, halos kalahati ng assets mo ay binubuo ng cash. Sa land naman, meaning sa 1,505,000 mo na assets, 3.99% lang nito ang iyong land. So, ganun din sa ating income statement. Ang magiging base natin dito ay ang net sales. So automatically, 100% siya. For our cost of goods sold, that would be 3 million divided by 5 million times 100, the answer is 60%. For gross profit, 2 million divided by 5 million times 100, the answer is 40%. Ganon din sa other income, that would be 4%. Sa revenues naman, 44%. Sa operating expense, 16%. Net income before tax, 28%. Sa income tax expense, it's 8.40%. Sa net income mo ay 19.60%. So for another example, let us also solve for its year 2020. So yung magiging base mo dito ngayon ay 4 million na lang. So if ang cost of goods sold mo ay 2,400,000 divided by 4 million times 100, that's 60%. Gross profit mo ay 40%. Other income is 7.50%. Revenues is 47.50%. Operating expense 22.50%. Net income before tax is 25%. Income tax expense is 7.50%. Net income mo is 17.50%. So let's try to analyze this data. So dahil ang base natin ay ang net sales, meaning ang benta natin ay 100%. So let's see kung ano ang bumubuo ng 100% na yan. So for example, 100 pesos ang benta mo. So punta tayo sa cost of goods sold. Diba ito ang amount ng binili mo na ang merchandise. So bago mo ibenta. Meaning, sa kada 100 pesos na benta mo, 60% or 60 pesos nito nakaalat sa merchandise. So 40% to 40 pesos lang ang benta mo. Punta tayo sa net income. So kada 100 pesos na benta mo, 19.60% lang ang kita mo, ang maiiuwi mo. So marirealize mo ngayon na parang bakit ang baba ng kita ko or bakit ang taas ng operating expense ko. So to sum up, let us once again review the formulas that were mentioned. So for the horizontal analysis, we're looking for the percentage change. So that would be current year minus base year over base year figure times 100. So itong horizontal analysis, tinatawag din na trend analysis or time series analysis. So ang mga financial analysts look at financial trends over periods of time, especially quarters or years. So punta naman tayo sa vertical analysis. What we're looking here is the percentage of total asset or total liabilities or total net sales. Statement line base over total base figure times 100. So vertical analysis can be used both internally by a company's employees, katulad ng ginawa natin sa income statements, or externally by investors. So investors can use vertical analysis to compare one company to another. This wraps up my section of presentation. Again, this is Kimi Raz Carmona for the seventh topic assigned in our group to horizontal and vertical analysis of financial statement. I hope I made this topic easier to understand. Thank you for listening. I'll now turn the presentation over to our next reporter.
Hi, good evening. This is Benisme Ferrer and this is my report. External uses of statement analysis. Number 1, trade creditors. It focuses on the liquidity of the firm. Liquidity is a company's ability to convert assets to cash or acquire cash through a loan or money in the bank to pay its short-term obligations or liability. Liquidity in stocks is important because it determines how quickly and efficiently you can buy or sell shares. High liquidity is associated with lower risk. Mananatili lang yung value ng liquidity stock pag yung nakakalakal ito. The market is busy and it's easy to find the buyer or seller on the other side. Number 2, bondholders. Focus on the long-term cash flow of the firm. A bondholder is an investor or the owner of the debt securities that are typically issued by corporations and governments. Bilang isang bondholder, may dalawa kang rights. The first one is to attain the bond's principal amount when it matures. And the second is to receive a frequent interest amount. Number three, shareholders. Focus on the profitability and long-term health of the firm. A shareholder of a corporation is an individual or legal entity that is registered by the corporation. Shareholder is any person, company, or institution that owns shares in a company's stock. A company shareholder can hold as little as one share. Ano nga ba ang pagkakaiba ng shareholder sa bondholders? Shareholders are those who own stock in a company. Tapos, ang bondholders naman, siya ang may-ari ng bonds issued by a company. Both investments offer the opportunity to make money, but there are risks inherent in each as well. When you purchase a company stock, you're essentially buying a piece or share of that company. Next, what are derivatives? How can they be used to reduce or increase risk? Derivatives are financial instruments in form only of legal contracts that derive their value from the value of the underlying assets of which they are based on. These are the derivatives: plan, control, and understand. Number one, plan. Focus on assessing the current financial position and evaluating potential firm opportunities. Number two, control. Focus on return on investment for various assets and asset efficiency. And lastly, understand. Focus on understanding how suppliers of funds analyze the firm. That's all. Thank you.
Good evening, everyone. I'm the last reporter, and I will be discussing common size statements and trend analysis. Common size statement is also known as vertical analysis. It evaluates financial statements by expressing each line item as a percentage of the base amount for that period. It also helps to understand the impact of each item in the financial statement and its contribution to the resulting figure. This analysis can be conducted in two ways: horizontal and vertical analysis. As the previous reporter discussed, the process of horizontal analysis would be calculating the change in amounts first before calculating the change as a percentage. In vertical analysis, each item is expressed as a percentage of a significant total. As you can see, there's a box highlighting the percentage part of the tables in horizontal and vertical analysis. The reason is that common size statements only show percentage and no absolute dollar amount. Let's proceed to trend analysis. Trend analysis is the process of comparing business data to identify any consistent results or trends. It shows changes over time in given financial statement items. It helps evaluate financial information for several years and understand how the business has performed. And it gives ideas about how a business might change things for improvement. In trend analysis, choosing a base year would be the first step. The first year is usually the base year. In this case, 1995 would be the base year and 1999 would be the latest year. The percentage for year 1995 would be 100 because it will be the basis of this analysis. The formula for trend percentage would be chosen year divided by base year times 100. For example, for revenues in 1999, 2,405 divided by 1,820 times 100, the answer would be 132.1%. For expenses in 1997, 1,870 divided by 1,701 times 100, the answer would be 109.9%. The formula for horizontal analysis can also be used in trend percentage. Chosen year minus base year divided by base year times 100. For example, the revenue in 1996 was 1,991,
1,991 minus 1,820 divided by 1,820 times 100, the answer would be 9.4%. 9.4% represents the growth in terms of revenue. In other words, the income of the business rounded up to 9.4%. On the latest year in 1999, the income of the business increased to 32.1%. And in terms of expenses, it increased to 19.5%. I hope you learned a lot from our presentation about financial reporting and analysis. This is Group 2. Thank you for listening.